Does your business operate within the UK construction industry? This sector can be particularly difficult to work in, given the nature of lumpy payments coming in and going out, which can put the business cash under a lot of pressure. Generally, work is also seasonal, so you may have a few months in the year where turnover is lower than usual, but you still have to keep paying your overheads to keep things ticking along. In this video, we're going to run through some tips and tricks specifically in relation to UK construction in order to help your business out and keep it going along through the tough times. We'll be discussing the working capital cycle and how best to maximise your business cash flows. We will then look at how best to account for your projects in order to see if you are profitable, your sanitary metric. Then finally, we will run through some tax programs which are specific to UK construction and let you know what to look out for to keep the tax man off your back. Stick around to the end as we highlight the severe consequences of getting this stuff wrong. Come with me and let's dive in. But before we do, don't forget to hit the like and subscribe button. Welcome friends, I'm Bradley Lay, a finance director and business growth coach, and have worked previously in construction for a good 17 years of my career. In this time, helping one particular construction firm grow from 12 million to 150 million. Here are the three most important topics that I would look into when giving advice to any construction company. Working capital cycle, accounting for construction projects and WIP, construction-specific tax considerations. Firstly, working capital cycle. Cash is king, and working capital is the lifeblood of your business. Basically the difference between what you owe versus what you're owed. You can either have positive working capital, which we really don't need to go into too much detail as it's pretty self-explanatory, or negative working capital. Negative cash flow doesn't necessarily mean bad news for your business. With negative working capital, an alternative view of looking at this is that your business's current liabilities are financing its current assets, as working capital is being generated through customer receipts and payoff from investments. This approach requires aggressive management of cash since there is little cash on hand. Invoices must be turned into cash quickly. Invoice finance, anyone? And investments must be judged very carefully, as one mistake can have severe consequences. Construction is different to other industries due to its unique legal and tax status, distinct credit policies and unusual supply chain. To be efficient, a construction project should be cash positive as soon as possible, meaning that receipts from clients need to be higher each month than payments being made to suppliers. For example, if you have agreed 30-day payment terms with your clients and agreed 6-day payment terms with your suppliers, then this means that you should in theory have a positive cash flow as your creditors are funding your working capital. Generally, an efficient construction company that operates this way tends to be cash rich, but at the sacrifice of being less profitable. Construction companies with a negative working capital tend to be heading towards faster growth and higher profits, but at the sacrifice of having lower cash reserves to fund problems or issues. This is why so many new construction companies find themselves to be profitable at the start, but then make the mistake of focusing purely on profit rather than considering cash as well. So ultimately they run out of cash and have to file for bankruptcy. Every year this happens to so many small construction firms. Take the advice in this video, focus on cash alongside profits and you'll be around for years to come. Another item to look out for in your cash flows, which may catch you off guard if you're not prepared, is payments to the taxman, HMRC in the UK. We will run through specific tax advice a little bit later in this video, but in terms of VAT, it's your business's responsibility to collect this from your customers, as well as payments towards corporation tax, and also PAYE employer taxes alongside CIS, Construction Industry Scheme. These amounts have to be deducted from your supply chain. These payments can be very significant, so ensure that you have enough cash in your bank to cover these as and when they fall due. You don't want to start pissing off the taxman and getting on the wrong side of HMRC. If you're struggling to make payment of your tax debts, then contact HMRC to discuss further, and they may even be able to help out by deferring payments of your taxes or agreeing to what is known as a time to pay arrangement. Be persistent with HMRC, they will do everything to avoid helping your company out if they can get away with it, i.e. like the bouncer who will not let you into a nightclub. But ultimately, if this is the only final option, then they tend to come around and will try to help out as best they can. Once you get past the bouncer, HMRC do not want to see your business fold because you could not meet your tax liabilities for a few months, so they will try to support where they can. However, be careful. One wrong move and the bouncer will be back and he'll throw you straight out of that club for good. There are many types of borrowings and financial products your business can get in place to help finance working capital. If you need any assistance with this, then please contact me directly, as I am personally able to assist companies in raising finance using unique lenders outside of the usual high street banks. I'll be doing a video in the future giving a deeper dive of these products, but essentially, options to raise finance include standard loans, overdrafts, RCFs, rolling credit facilities, asset-backed finance, invoice factoring, supply chain finance, also known as reverse factoring, credit cards, property finance. The list goes on, and you can see that there's a number of options to help your business out if you need to raise finance. Ensure you regularly forecast your cash flow. As I always say, Cash is king. See my video linked above, Cash Flows Explained, where I give a deeper rundown of cash flow forecasting and help you put this together. Secondly, accounting for construction projects and WIP. In construction, we are working on projects which can last some length of time, typically from 6 months all the way to 2 years and beyond. When accounting for the profit and keeping track of this, the best way is to apply the anticipated final margin of the project against the turnover invoice to date. By doing this, we create a WIP amount on the balance sheet. Work in progress. The WIP amount is the forecast cost to date, less the actual cost incurred to date. If the WIP shows a minus value, i.e. reflected as a creditor on our balance sheet, then this is good news and shows that we are incurring less cost than expected, so the project is efficiently self-funding. To calculate the initial margin to be applied, this is usually taken from the profit forecast at tender stage. This is why it is so important to ensure your tenders are as accurate as possible. For smaller firms, a rough guide for tenders is calculated based according to the works being undertaken and then applying a market estimate based on square footage or meterage. Once we start performing works on the project, we would tend to use a job costing system to capture these costs as they are being invoiced to us. This alongside cost heads, which would record the specific class of costs. For example, you may have a cost head for labour, a cost head for material, a cost head for subcontractors. Once a month, it is a good idea to review these costs against the original tender costs and update your rolling forecast accordingly. It could be that the client has instructed further works or the programme has changed significantly since the initial tender. The process of reviewing and reporting these costs is called a CVR, or cost value recognition. By using the tools we have mentioned here, you will be keeping a close eye on your costings and therefore should be able to set relevant strategies throughout the project life cycle. Can we negotiate further discounts with our supply chain? Do we require longer payment terms at certain times of the project life cycle if we feel that there is going to be a cash pinch? Do we need to look at raising temporary finance to assist with particular parts of the project? Thirdly, tax specific to UK construction. There are 3 main taxes we are briefly going to touch on. To be honest, there is so much detail to run through on these, I'll probably dedicate an entire video to each of these separately in the future. Do let me know in the comments if this is something you'd like to see. To briefly run through these taxes, they are CIS, VAT and IR35. Any business that operates in the UK construction market will need to be registered under this scheme, which is allocated to a company's UTR number, unique tax reference number. Generally speaking, there are 3 rates applicable and it is down to the company you invoice, your client, to deduct the correct percentage from your invoice. And this is deducted on the labour amount only. Higher rate is 30% and the amount deducted by a client if the supplier does not have a UTR or is registered under CIS. Lower rate is 20% and the amount deducted for smaller companies turning over under 30k or not registered for gross status. And gross status is the 3rd rate applicable and covers companies who have applied and been accepted for this. In practice, this basically means that no deductions are taken from payments as the company has proven to HMRC that they are tax compliant and accordingly trusted with their tax affairs. Another tax we're going to briefly look at is VAT, value added tax. There are various rates and situations where different amounts of VAT will be used in construction, but very high level and very generally, the industry now falls under a reverse charge. So no VAT actually changes hands during the payment stage. This is accounted for on the company's VAT return. Under reverse charge, you only need to charge VAT to what is known as the end user, i.e. the final company in the building chain that is going to be using the building, the end product. Examples of an end user would be a developer who is paying for the project to be undertaken and will use this for its own purpose, or a company that has paid a construction firm to construct a building in order to rent out as accommodation or office space. HMRC have the power to remove gross status if a company fails to meet its tax liabilities or is deemed to be non-compliant. The final tax we're going to quickly run through is off-payroll working, also known as IR35. This is a tax applicable to limited companies who provide their own services to a client as an individual, known as a PSC, a personal service company. Again, there are many rules to run through, so we'll not go into specifics. But higher level, the onus used to be on the limited company providing the services to decide whether IR35 tax applied. From April 2021, this changed to place the onus on the company who engaged with the supplier to make the decision themselves if IR35 tax should be applied. If this tax is not deducted and HMRC decide it should have been, then the company who engaged with the supplier is liable for all the tax associated with the engagement. And this would generally be backdated to when the first invoice was paid and would probably incur additional penalties, interests and fees. So again, don't mess about when it comes to your tax compliance across these 3 areas. The consequences are severe. I hope you've enjoyed watching this video today and helped improve your approach to finance and accounting in the construction industry. Don't forget to hit the like and subscribe button to this channel. Please feel free to view some of my other content, in particular this video called Financial Statements Explained. Here we run through exactly how to understand your accounts and financial statements and learn how to best leverage these to obtain funding in your business. Thanks for watching and look forward to seeing you again in the next video.